All right, so let's really unpack this one. We are diving into a company that operates so fundamentally beneath the surface of the modern tech world that most people, I bet, have never even heard its name. Yet without their software, the fundamental architecture powering every single new advanced chip, the silicon that's enabling all these AI breakthroughs, the processors in your phone, the hardware in those huge data centers, it simply could not be designed.
We're talking about Synopsys, Inc.
Mm-hmm.
The ticker is SNPS.
Mm-hmm.
And, the sources we've been reviewing, they've rightly dubbed it the architect of the silicon singularity. And honestly, that's not really an exaggeration. They kind of hold the keys to the future of computing.
And our mission today is laser focused. We're going to be dissecting the fallout, the implications of one of the most transformative, high-stakes bets in recent tech history.
Yeah.
And that is Synopsys' massive, complex, $35 billion acquisition of a company called Ansys. This deal just closed in July of 2025, and it wasn't just, a big merger. This was a total aggressive strategic pivot.
And what's so fascinating here is the timing of the deep research report we analyzed.
Mm-hmm.
It's dated December 10th, 2025, so it captures that immediate financial aftermath. Right after the company released its full fiscal year 2025 results, it gives us this perfect snapshot of a company in a profound high-leverage transition.
Which brings us to the big question we're tackling today, and it's a classic one. It's quality versus price. Is this duopolistic powerhouse now essential not just for designing the silicon, but for guaranteeing the whole system works? Is it a wonderful company at a fair price, in that classic value investing mold?
Wow.
Or does that huge debt load they took on, does that introduce a level of financial fragility that the market, which is pricing it at a premium right now, is just completely overlooking?
We really have to anchor this in the hard numbers they just delivered for FY 2025. I mean, they reported record revenue of over $7 billion. That's $7.054 billion, which is an impressive 15% year-over-year growth.
Yeah.
So the underlying business momentum is incredible. And they also exited the year with a record swollen backlog of $11.4 billion. That's essentially guaranteed revenue over the next few years. These are phenomenal numbers.
They absolutely are. But those top-line figures, they completely mask a fundamental, really dramatic shift in the company's capital structure.
Precisely. And that shift is defined by one number, the $15.14 billion in new debt they used to finance the Ansys deal. That single figure, it changes everything about the risk profile of Synopsys.
Everything.
Historically, this was a conservative net cash company. Now they are heavily levered, and the entire investment thesis, everything, hinges on flawless execution.
That debt figure is the true ghost in the machine, isn't it? It's forcing all these immediate changes.
It is, and that execution is built on this single, compelling idea they call the silicon to systems narrative. We really need to spend some time on what that means because the market is pricing in, flawless execution of that vision. Synopsys is trading at a premium multiple right now, around 36 times earnings.
Which is a valuation that says investors believe they're going to hit every synergy, sustain this crazy growth, and just seamlessly integrate two massive companies.
No room for error.
And for you, the listener, this deep dive, it isn't just about one stock's balance sheet. This is about understanding these foundational shifts happening in technology. It's about how AI, how this complex 3D chip architecture, system reliability, how it's forcing the hands of even the most entrenched players. If Synopsys pulls this off, it really sets the template for how these foundational engineering services will evolve for the next, 20 years.
So let's jump straight into the catalyst for all this, the $35 billion acquisition of Ansys. It wasn't a luxury. Our sources paint it as an absolute necessity, and it was triggered by the one phrase that just dominates high-end chip design today.
The slowing of Moore's law.
Slowing of Moore's law. That's the economic and the physical catalyst right there. For decades, the path to performance gains was, linear and predictable. You shrink the transistor, you pack more on the die, and the chip gets faster, smaller, cheaper, is that famous exponential curve. But the physics are pushing back hard.
Yeah, we're hitting atomic scale limitations now, right? Where quantum effects start messing with reliability, and just the cost to build a new fab for these smaller nodes like TSMC's N2 is astronomical.
Exactly. Transistor scaling is just becoming exponentially more expensive and physically challenging. So the engineers, they had to innovate outside the box, or maybe more accurately, outside the two dimensions of the chip surface. Innovation moved laterally and vertically into architecture. We're talking about three key architectural shifts.
Okay, so the first one is that vertical shift you mentioned, dash 3D IC stacking.
Yes, 3D IC stacking. You're physically layering different components logic on top of memory, for example. To shorten the distance, data has to travel. Then second, you've got chiplets, where you break up a giant monolithic chip into smaller, specialized components and connect them. And third is heterogeneous integration, which is combining different types of processors like CPUs, GPUs, AI accelerators, all in the same package.
Which sounds incredibly clever from a performance standpoint, but you can just imagine the engineering headaches. And these are headaches that Synopsys, the king of 2D logic design, suddenly couldn't solve on its own.
Profound headaches. Think of it this way. Traditional EDA software, electronic design automation, it focuses purely on the electronic logic, the timing, verifying the digital behavior of the circuit. But when you stack chiplets, you introduce all these physical problems that have nothing to do with the logic itself.
Can you give us a concrete example? What kind of physical problem are we talking about?
The most immediate and catastrophic one is heat. Just imagine stacking these components like floors in a skyscraper. The lower floors, especially those logic layers, they generate a massive amount of heat, but they have immense difficulty getting rid of it because of the layers on top. This leads to what engineers call thermal throttling.
Where the chip has to slow itself down just to avoid melting.
To avoid melting, exactly. So a perfect digital design can completely fail in the real world because the physics were ignored. You also get something called crosstalk electromagnetic interference, or EMI, between those vertically stacked layers.
So the tools that Synopsys sold were great at designing the logic gates.
Fantastic at it.
But they couldn't guarantee the chip wouldn't, melt down or crack under stress or short circuit from EMI once you actually turned it on. The risk moved from a design error to a physical failure.
That's the perfect analogy. The traditional EDA tools could design the brain, but they couldn't confirm the body was structurally sound or had adequate cooling.
And that's where Ansys comes in.
That is exactly where the Ansys solution steps in. Ansys provides the world-leading physics-based simulation capabilities, what's often called multiphysics. Their software lets designers simulate thermal gradients, structural integrity, how materials respond to heat and stress, and even fluid dynamics for cooling systems. And they do it concurrently with the electronic logic designed by Synopsys.
So it's the convergence of the digital and the physical world.
It is. The acquisition isn't just an expansion, it's a strategic necessity to solve the fundamental technological barrier facing the entire semiconductor industry today. By creating this unified platform, what the research calls a design analysis continuum, Synopsys has completely transformed its DNA. It's not just an indispensable vendor for the silicon die anymore.
Right.
It's now an indispensable vendor for the entire electronic system or package.
Which leads to a much, much larger market opportunity. They're not just selling to chip makers anymore.
Absolutely. That whole silicon to systems mantra isn't just clever marketing. It's the key to their diversification. This pivot expands their total addressable market, their TAM, to about $31 billion. They're moving aggressively into these adjacent high-growth verticals.
Like automotive, for instance.
Precisely.
Right.
In the automotive sector, they're not simulating a single chip. They're simulating entire systems. Think about an autonomous vehicle. You have to simulate the thermal management of this huge sensor suite, the structural integrity of the radar units, the complex electromagnetic shielding you need for safety, all while you're verifying the complex AI logic that's actually driving the car.
Wow.
Aerospace, industrial. These become huge new revenue streams. So that $35 billion price tag, it starts to look less like a single purchase and more like the cost of buying an accelerated future.
And that necessity, it leads us perfectly into the bedrock of Synopsys' whole investment thesis. It's enduring competitive advantage. It's moat. I mean, when we talk about quality companies, we're always looking for businesses with that high recurring revenue, that deep customer entrenchment. And this is where the business architecture of Synopsys truly shines.
It's arguably one of the most stable and defensive business models in the entire technology sector. And it's all built on a foundation of long-term dependency. Let's start with the revenue architecture. Roughly 80% of their revenue is recurring.
80%.
80%.
Yeah.
This comes from long-term time-based licenses, usually 3 years, plus these mandatory high-margin maintenance contracts.
That model gives management and investors just incredible financial visibility. It's so predictable, especially when the broader chip market goes through a downturn, and you see that reflected in their record $11.4 billion backlog. That's money that's virtually guaranteed.
That visibility is a fortress. And that structure translates into exceptional customer retention.
Yeah.
I mean, the retention rates in the EDA industry are cited as being near 100% for enterprise accounts.
Yeah.
It's hard to overstate how defensive that is. Churn is almost non-existent.
So the famous switching cost moat, is at its absolute most powerful here. It's not just the price of the software license, but the massive operational cost of trying to move to a competitor like Cadence.
The switching cost is operational, it's financial, and it's temporal. This software is the central nervous system of a chip designer's entire R&D process. Retraining a whole team, hundreds of specialized, highly paid engineers on a new workflow, takes years. Plus, adapting all your existing design libraries to new tools. It introduces massive risk.
Let's put a fine point on that. To bring this to life, we saw reports that one major fabless firm estimated a full switch would cost them 2 full years of R&D momentum.
That's entirely realistic.
2 years. That's billions of dollars in lost market opportunity.
Billions. Because the stakes are so high. I mean, a typical advanced chip design costs hundreds of millions of dollars before you even start fabrication. No executive is going to risk a 2-year delay. The tools are just too deeply integrated. Once you commit to Synopsys for a major product family, you are locked in for decades. The software literally becomes a part of the customer's own IP.
So let's break down the 3 core segments that benefit from this lock-in, starting with the bedrock, design automation or EDA.
Right. This is the core engine. And within design automation, you've got the digital design tools like Fusion Compiler, which does the complex placement and routing of trillions of transistors. But the real key here, the growing bottleneck in modern design, is verification.
Verification is the insurance policy, right? Making sure the logic actually works before you commit billions to fabrication.
Precisely. And verification is where the engineering spend is increasing the fastest. They offer sophisticated software simulation, like their VCS simulator. But what truly shows their commitment to this high-end infrastructure are these incredibly expensive, specialized hardware emulation systems they sell, specifically ZeBu and HAPS.
What makes those hardware systems so indispensable?
Well, these aren't just software programs. These are massive room-sized machines filled with hundreds, sometimes thousands, of high-density FPGAs. They basically let engineers run the entire digital logic of a chip at speed long before it's physically made.
Wow.
So they can run billions of clock cycles per second. If a bug is found late in the design process, which these systems are designed to catch, it saves the customer hundreds of millions of dollars and months of delay. The necessity of these systems, it just reinforces that lock-in dramatically.
Okay, segment 2 is design IP, intellectual property. They're number 2 after ARM, and this is where they really leverage network effects.
That's right. ARM dominates CPU cores, but Synopsys dominates the interface and connectivity IP. We're talking about USB controllers, the complex PCIe interfaces connecting GPUs to CPUs, the really difficult DDR5 memory controllers. Chipmakers almost never try to design these complex standards-based blocks from scratch. They license these pre-verified, foundry-approved blocks from Synopsys.
And that leads to that powerful network effect you mentioned.
It's a self-reinforcing loop. The big foundries, TSMC, Intel, Samsung, they have to certify which IP blocks work reliably on their most advanced nodes like N3 or N2. And they certify Synopsys' IP first because of its market share and quality. Once it's certified by the foundry, that Synopsys IP becomes the default low-risk choice for everyone else. It locks customers into the entire ecosystem.
And segment 3 is the new core competency, simulation and analysis, the Ansys piece. This completes the platform.
It creates a true end-to-end service. Synopsys went from selling the tools to design components to selling the components themselves with IP to now selling the ability to physically guarantee the system's performance and reliability. It's the definition of a deepening moat.
We also have to talk about the massive tailwind from AI, because Synopsys is monetizing AI not just as some marketing pitch, but as a practical solution.
Their Synopsys.ai banner is absolutely critical to the growth thesis. They use reinforcement learning to autonomously optimize a chip's power, performance, and area, or PPA. And why is this huge? Because there's a global shortage of chip design talent. If Synopsys' AI can get you a 10% or 15% better PPA result and do it 50% faster than a human team could, that's an enormous economic proposition. It drives huge upsells.
And finally, there's the duopoly structure itself. It's just Synopsys versus Cadence Design Systems, CDNS.
A textbook duopoly, the envy of most industries. Synopsys has about 38 to 40% of the market. Cadence has about 36 to 38%. Combined, they control about 3/4 of the entire global EDA market. And that structure is paramount because it gives both of them incredible sustained pricing power, and it acts as this nearly impenetrable barrier to new entrants.
So how do they stack up now after this merger?
Well, Synopsys' historical edge has always been its portfolio depth. They're the leader in crucial areas like logic synthesis and signoff, and they dominate that interface IP we talked about. Cadence, on the other hand, they're particularly strong in analog and mixed signal design, and they had faster organic growth in system design. until this Ansys deal really forced Synopsys' hands.
But the bottom line is the duopoly protects them both from price wars.
Exactly. And the Ansys deal just widened Synopsys' wide moats significantly. It raised the barrier to entry to a near impossible height. For a competitor to challenge Synopsys now, they don't just need world-class EDA software. They also need to replicate the world's leading physics-based simulation engine. That's a technological and capital requirement that very few companies on the planet could even hope to meet.
Okay, so we've established the strategic vision, the wonderful company part, but now we have to pivot to the financial reality, and this is where the picture gets, well, considerably more complicated. We have to look beyond the top-line growth to the financial consequences of that massive $35 billion expansion.
Yeah, we have to look at the fine print. I mean, if you look at the 10-year trend before the merger, Synopsys was this remarkably consistent compounder. From 2015 to 2025, they had a revenue CAGR of 12.1%. And crucially, they avoided a revenue decline in any of those years, even during the big semiconductor downturns.
And that growth actually accelerated in the last few years.
It did. It went from the 7 to 9% range up to 14-15% between 2021 and 2025. And that reflects that structural shift we talked about. As Moore's Law got harder, chip makers had to throw more and more R&D money at design and verification tools. Synopsys got a bigger piece of that pie.
And historically, they showed that classic software operating leverage.
Absolutely. A textbook definition. As revenue scaled up, their operating expenses grew at a much slower rate. This allowed their non-GAAP operating margin to expand substantially, hitting a really robust 38% in 2024. They were immensely profitable and very efficient.
But 2025 is a profound inflection point. We have to talk about the huge divergence between their GAAP and non-GAAP margins. The source material highlights the GAAP operating margin was only 17.2% in 2025, while the non-GAAP was 38.5%. That's a 21-point gap. That's alarming.
That gap is the financial headline of the merger. It screams transition. And the divergence is driven mainly by 3 large, non-cash or non-recurring charges that are directly tied to the acquisition.
Okay, let's start with the largest, amortization of intangibles.
This charge was over $504 million in 2025. When Synopsys bought Ansys for $35 billion, they paid this massive premium over Ansys' tangible book value. Accounting rules say you have to allocate that premium to intangible assets like Ansys' customer relationships, its brand, its technology, and then you have to amortize or expense the value of those intangibles on the income statement over their useful life. So this immediately hits your GAAP earnings hard, even though it's a non-cash expense. It's why their GAAP earnings are going to look depressed for years.
And the second major source of that gap?
Stock-based compensation, or SBC. This totaled a staggering $893 million in 2025. And this expense is routinely excluded from the non-GAAP figures that management loves to talk about, but it represents a very real dilution cost for shareholders.
Can you contextualize that number for us? $893 million in SBC. How does that compare to other metrics?
Well, if you look at the financials, that $893 million is close to 13% of their total revenue for 2025. But more critically, it's over half of their reported GAAP net income. It's significantly diminishing the actual profit that's attributable to existing shareholders. And this scale it's problematic. It's why value investors, especially those following Buffett's principles, look at heavy SBC with a lot of skepticism. It boosts management incentives, sure, but it's basically paying employees with future shareholder equity.
Which makes the third point, the balance sheet pivot, even more dramatic. I mean, historically, Synopsys was a textbook conservative company.
It's extremely conservative. They often had a net cash position, more cash than debt, and they used their huge free cash flow for aggressive share buybacks. They bought back about $3 billion in stock between 2015 and 2021. They were a poster child for responsible capital management.
And that reality is completely inverted now.
It is the new reality, as defined by leverage. To finance this merger, their total debt skyrocketed from about $2.7 billion in 2024 to $15.14 billion in 2025. They leveraged up their fortress-like balance sheet to make this happen, and that demands a profound reevaluation of their financial risk.
And in the current interest rate environment, that debt carries a substantial real cost.
A very real and growing cost. They paid about $252 million in interest expenses just in the first 9 months of fiscal 2025. So this introduces significant interest rate risk, which was totally absent before. That $250 million annual interest expense is a huge drag on GAAP earnings and puts immediate pressure on management to generate cash.
So this massive debt forced immediate operational changes. How is the new CEO, Ghazi, tackling this mandate to deleverage and get these synergies at the same time?
That is the core challenge defining his tenure. The immediate priority is rapid deleveraging. Management has suspended all share buybacks indefinitely. They just can't afford to return cash to shareholders when they have $15 billion in debt to service. All excess free cash flow is now going straight to debt repayment.
And what's the target for that debt reduction?
Their goal is to get their net leverage ratio below 2.0x EBITDA within 2 years of the merger closing. And to hit that timeline, they need absolute flawless cash flow generation and aggressive cost cutting. And you can see that urgency in the November 2025 restructuring they announced. They're planning to reduce the global workforce by about 10%, which is roughly 2,800 roles. It's a difficult decision, but it underscores how urgent this is.
Shows they're moving decisively. We also saw some shifting insider sentiment in the sources.
Yeah, there was some notable selling activity by top executives, including the CEO and CFO, late in 2025. Now, this can be standard practice for diversification after a big stock run-up, but the absence of any large open market buying by executives at this valuation, it suggests that even management, while confident in the strategy, doesn't see the stock as deeply undervalued right now. The modest purchase by one director offers a small vote of confidence, but the overall signal is one of execution, not deep value.
All right, now we move to the ultimate question. What is this new transformed levered business actually worth? We have to look at how analysts modeled its future using the gold standard of financial analysis, the discount cash flow, or DCF.
Yeah, and the DCF is really the only tool rigorous enough to quantify the value of these highly speculative Ansys synergies over the next decade. It's a 10-year model, and the crucial thing for our listeners to understand is that the final value is completely dependent on the assumptions you use. And the assumptions here are, well, they're optimistic, aggressive, but maybe achievable.
Let's get into those growth assumptions. The model has to assume accelerated growth to justify paying the acquisition premium.
It certainly does. They start with the FY 2026 guidance, which is about $9.6 billion. Then the model assumes this accelerated growth phase between 2027 and 2031, rejecting a very strong 12% compound annual growth rate. This is a highly aggressive assumption. It's significantly higher than their historical organic rate of around 10%. So that 12% growth explicitly prices in the seamless success of Ansys cross-selling and the continued momentum from Synopsys.ai.
So if that Ansys integration stumbles, or if the expansion into aerospace or automotive is slower than they think, that 12% growth rate might be unreachable.
Exactly. The synergy engine has to fire perfectly. Beyond 2031, the model tapers down the terminal growth rate to 8%, which, by the way, is still very strong. It reflects this belief that the semiconductor design industry is just so essential that it should grow faster than global GDP forever.
And what about profitability? The model must assume continued margin expansion, even with all the integration costs.
It does. It assumes powerful cash flow and margin expansion. The non-GAAP operating margin is modeled to expand from 40.5% in 2026 all the way up to 43% by 2031. And this expansion hinges entirely on realizing those cost synergies from the 10% workforce reduction and just efficiently scaling the unified software platform to a much larger revenue base.
And free cash flow, FCF, that's the engine that's going to fund the deleveraging. How robust is that projected cash flow?
FCF is the company's most important asset right now. They generated $1.74 billion in 2025, and management is guiding for about $1.9 billion in 2026. This immense cash flow is the only thing that justifies taking on $15 billion in debt. Every dollar of that FCF is immediately earmarked for debt repayment.
The cost of capital, the WACC, that must reflect the dramatic change in risk from all this debt.
It's crucial. The WACC used in the model was about 9.2%. That's the discount rate used to bring all those future cash flows back to today's dollars. It incorporates a 10% cost of equity, but also the lower cost of the new debt structure.
So that 9.2% WACC is essential because it directly reflects that new debt risk.
Precisely. Every future dollar of cash flow from Synopsys is now discounted more heavily than it would have been before the acquisition. Pre-merger, when they were net cash, their WACC would have been lower, maybe closer to 8 or 8.5%. The jump to 9.2% reflects the market's new, higher perception of financial risk because of the leverage.
So when you project all that out, factor in the aggressive growth, the expanding margins, and then subtract the significant net debt of $12.6 billion. What was the implied value?
The model suggested a total enterprise value of $94.5 billion, which resulted in an implied equity value of $81.9 billion.
Which translates directly to an implied share price of
approximately $493.
So what does that mean for you, the investor, looking at the market right now?
Well, the conclusion is that with the stock trading around $466 as of early December 2025, the analysis suggests the stock is fairly valued. It offers a very limited upside of roughly 6% to that calculated intrinsic value. The market has been incredibly efficient here. essentially assuming that all those aggressive assumptions, the 12% growth, the 43% margins, the perfect integration, are going to be achieved. There is no major mispricing or discount here for new buyers.
Now let's shift from the spreadsheets to, I guess, philosophy. Let's apply that qualitative filter that so many successful long-term investors, including Warren Buffett, use. Does Synopsys pass the quality test? This is really essential for gauging the temperature of the market's enthusiasm versus the company's underlying quality.
Yeah, this brings the whole analysis full circle. Buffett seeks wonderful companies at a fair price. We know the strategic move was visionary, but now we test the qualitative standard.
Okay, criterion 1. Is the business simple and understandable?
Verdict, yes. I'd say a strong yes. While the technology is bleeding edge, unbelievably complex, the business model is beautifully simple. Synopsys sells the necessary, non-negotiable digital pickaxes for advanced chip design. The subscription model makes revenue predictable, and the core functions clear. If you design a modern chip, you have to pay rent to Synopsys or Cadence.
Criterion 2. Does it have a durable competitive advantage? The moat?
Verdict, strong yes. The moat here is exceptionally deep. It comes from those immense, crippling high switching costs we talked about, the duopoly pricing power, and those powerful network effects from foundry certification. And the Ansys deal just fundamentally deepened this moat, making their platform irreplaceable. This advantage is structural, not fleeting.
Okay, criterion 3. Does it have able and honest management?
Verdict, mostly yes. I'll say mostly because management has shown visionary strategy with this silicon to systems pivot, and they have a strong operational track record. However, we have to acknowledge that big caveat. The heavy reliance on stock-based compensation, that $893 million in 2025, that's a factor that really conflicts with classic value investing principles. The strategy is sound, but the compensation structure needs careful monitoring.
And criterion 4, which is always the hardest one to pass when a company is riding these strong secular tailwinds, is there a sufficient margin of safety on the price?
Verdict, no. This is the deal breaker for new value investors. The stock is trading within, 6%, 10% of its calculated intrinsic value? A margin of safety is absolutely necessary to account for errors in growth assumptions, integration difficulties, the debt, or just sudden macroeconomic shocks. The current price fully assumes perfect execution.
So we are being asked to pay 100% of the intrinsic value for a company that just leveraged its balance sheet from net cash to $12.6 billion in net debt. That lack of downside protection is the real issue. It's the difference between a wonderful company and a wonderful investment opportunity today.
It is the market temperature speaking loudly. A stock trading at 36 times earnings shows very high expectations. And for our listeners who are tracking this overall market temperature and looking for that crucial context, that margin of safety, we want to remind you to check out and download the iOS app Buffett Indicator from the Apple App Store. Monitoring that overall market valuation can really provide context on whether premiums like the one Synopsys commands are generally sustainable or if the entire market is stretched. Synopsys' valuation is a direct reflection of that high market temperature right now.
That's an excellent point. The price is fully reflecting all the optimism, leaving very little room for error.
That's the dilemma. They are positioned perfectly for the future, but you are paying a premium for that perfect future today.
So let's try to synthesize everything we've learned. Synopsys is an exceptional, wonderful company with a deepening moat. It's strategically positioned for this critical era of AI and 3D IC design. They have cemented their role as the indispensable utility for next-gen electronics. But, and it's a big but, the market is demanding flawless, high-speed execution after they took on that massive $15 billion debt load from the Ansys merger.
The strategic move was absolutely necessary. It transformed them from just a silicon design utility to a full system engineering platform. They have high recurring revenue, expanding margins, a structural duopoly. But as we confirmed, great companies are not always great investments at any price.
So what's the final investment verdict based on this rigorous analysis?
The recommendation remains hold for existing shareholders. If you already own this compounding asset, the tax implications and the long-term quality usually outweigh trying to time the market. However, for new investors looking for a discount, the verdict is a firm watch. The current valuation just offers very limited upside relative to the heightened risks we've outlined.
And what would be considered a fair price? A price that provides that necessary margin of safety that Buffett requires to account for unexpected turbulence.
The report suggests that a more attractive entry point, one that accounts for inevitable errors in integration, market volatility, and the new debt burden, that would be in the range of $380 to $400. That price would provide a much clearer margin of safety and a significantly more favorable risk-reward profile.
We have to close by reemphasizing the 3 critical risks that could derail this otherwise excellent story. These are the things you absolutely must monitor.
Okay, risk number one is geopolitical risk, specifically regarding China. China historically accounted for a significant portion of their revenue, and the continued tightening of U.S. export controls limits their ability to sell advanced tools and IP to key Chinese customers. This was already a drag on IP revenue in 2025 and remains highly volatile. Any escalation here could severely dampen the growth forecast.
Risk number two is the integration risk.
Merging two large, successful engineering cultures, Synopsys' logic focus and Ansys' physics focus, is notoriously difficult. Failure to seamlessly integrate the technical stacks and, critically, the sales teams could lead to a disjointed product offering and a slowdown in synergy realization. If the customer experience suffers, it would be an immediate opportunity for Cadence to gain market share. That's $35 billion worth of operational risk that needs to be perfectly managed.
And finally, the increasing customer concentration risk.
As the massive hyperscalers Google, Amazon, Microsoft continue to bring their chip design in-house, they become these colossal single customers. This consolidation gives them immense negotiating leverage over Synopsys. They could demand aggressive pricing or, more dangerously, threaten to develop their own internal EDA tools for specific workflows, shifting the leverage away from the duopoly.
And that brings us to our final provocative thought. This deep dive has shown us that Synopsys is betting its entire future on AI-driven design, using reinforcement learning to autonomously solve this PPA optimization crisis.
It's the core premise of that whole Silicon to Systems narrative. They're using AI to solve the complexity crisis that Moore's Law created.
So this raises a really important question for you to consider as you digest all this. Will AI, which is optimizing PPA for customers, eventually become so sophisticated that it enables entirely new, nimble EDA competitors to bypass the current duopoly? Maybe by automating low-level design tasks and lowering the barrier to entry. Or will AI simply create a new proprietary layer of complexity, a massive data moat that only Synopsys and Cadence can afford to build and maintain, thus reinforcing their dominance and their exceptional pricing power for the foreseeable future?
That is the fundamental technological tension that's going to define the next decade of chip design. And the answer to that question determines whether the premium valuation Synopsys commands today is truly justified.
Absolutely fascinating. We hope this deep dive provides you with the clarity and context you need to understand this incredibly complex corner of the tech world.